If you've been around for a while, then you know how much I care about financial freedom for all. One thing that often gets in the way of that is debt. That's why I'm happy to announce that I've partnered with an amazing organization called Juno. Juno helps you get lower interest rates by using the power of group negotiation. It is a completely free resource that you can use to secure lower interest rates on new and existing student loans. Head to the link in the episode show notes to find out more. This is the Dreamers Podcast, episode 35, with certified public accountant and tax strategist Michel Valbrun. Today is September 14th, 2021.
If you don't have an efficient tax strategy, more than half of your income can go to paying money in taxes. Taxes are your single largest expense. When you make money, you pay income tax. When you buy something, you pay sales tax. When you purchase property, you pay property tax. When you sell the property for more than what you pay for, you pay capital gains tax. When you die, right, someone could potentially pay estate tax. But I think the biggest tax of them all is what I call ignorance tax. Because people don't have the knowledge as it relates to saving money on taxes, they end up overpaying in taxes.
Hello, world. Welcome to the Dreamers Podcast. I am Stephanie Anne-Lyse, also known as Anne-Lyse Wealth. I am a financial coach and an author. I self-published my first book, Dream of Legacy, a guide to help dreamers reach financial independence and build generational wealth. In this podcast, I'll have conversations with experts and thought leaders who dare to follow their dreams. You'll hear about their journey and their money stories. I hope it inspires you, dreamers out there, to live life on your own terms.
Come on, dreamers, let's change the world!
This podcast is brought to you by Dream of Legacy. Check out dreamoflegacy.com for resources to assist you on your journey to financial independence. Before we get into today's episode, please take a couple minutes to go into Apple Podcasts, if you're listening from an Apple device, to rate and review the podcast. If you appreciate the free resources that are provided in this podcast, then the best way to let me know is to do just that. Reviews help the podcast be more visible, and it helps other dreamers discover the podcast. So thank you. I appreciate you. And now let's get back to today's episode. Hello, welcome to the Dreamers Podcast. I'm your host, Anne-Lyse Wealth. Thank you for tuning in to today's episode. I am so glad you're here. Today, I'm chatting with Michel Valbrun. Michel is a certified public accountant, an award-winning author, a contributor at Entrepreneur Magazine, and a speaker. He is the president of professional services firm Valbrun Group. His work has been featured in various magazines and journals such as the Business News Daily, the AICPA Journal of Accountancy, The Street, and many more. His book, Prolific Profit: How Successful Businesses Maximize Profits and Dominate the Market, is inspired by the late and great Nipsey Hussle. So today we're going to talk with Michel about how to maximize our tax benefits. We're going to cover different ways that you can save money on taxes, how to determine which entities you should pick to start your business. We're going to talk about different retirement accounts and so much more. All right, so here is Michel Valbrun. Michel Valbrun, welcome to the Dreamers Podcast.
Thanks for having me. Super excited to be on here.
Can you tell our listeners a little bit about you and what you do?
Absolutely. So, hello, listeners. My name is Michel Valbrun, aka Money Making Mitch. I'm a certified public accountant, tax strategist, and award-winning author. And basically what I help you do is help you save 5 to 7 figures in taxes legally and ethically. So really my goal is to helping you learn how to keep more of your money from Uncle Sam, and then also be able to use that money to be able to create generational wealth for yourself and your family.
It all sounds very good. So we hear it all the time, taxes, they favor entrepreneurs and businesses, not employees. Can you elaborate on that and how an efficient tax strategy can actually help build generational wealth?
Yeah, that's a great question. And yeah, you're absolutely right. So the tax code does favor entrepreneurs, investors, and business owners. And really, my philosophy, or really why I think the way it is because in the government's eyes, really what they've realized is, so first of all, having people pay taxes is an invented concept, right? If you think about it, someone had to came up with the idea. Let's say, hey, I think it makes sense to start collecting money from the people in our community, in our location. So they came up with taxes, and they noticed that when they started taxing people, it impacted the activities that they did. So with that, I think the government realized that, hey, we want to incentivize people to be business owners and entrepreneurs. So if we give business owners, entrepreneurs, investors tax breaks, then it's going to incentivize more people to do those things, because in the government's eyes, these people who pursue those kind of activities end up creating wealth. They provide jobs, they provide services, they provide commerce, they provide housing, they invest into other companies, and ultimately help grow the economy. So as it relates to saving money on taxes, yeah, one of the big things that you could do is potentially look into starting a business, because not only does it create wealth for yourself and your family, but also you are able to have different tax incentives. Those tax incentives being, there's more deductions that you could take as it relates to taxes. There are different retirement vehicles that you could take. You could also be able to pay for certain expenses like meals, travel, things that you're already doing in your life. You're able to pay that through your business and be able to take a deduction for that for tax purposes. So yeah, it's a huge advantage.
So when you mention retirement, can you maybe talk about the differences between maybe contributing through your employer's retirement accounts and, as an entrepreneur?
Yeah, absolutely. So one of the main retirement accounts that you'll have as a W-2 worker is going to be a traditional 401k. So with the 401k account, it's just a pre-tax contribution. You go ahead and contribute to that during the year. And one of the things that you can do is you can contribute up to $19,500 for 2021. And then you're able to take that as a deduction for tax purposes. So you're able to get a deduction for that for this year. But then when you pull out that money for retirement, then you have to start paying taxes on it. As an entrepreneur, you also have 401ks. You can create what's called a solo 401k if you're just a single business owner, don't really have any employees. You could also contribute into what's called a SEP IRA, SEP IRA, which stands for Simplified Employer Pension Individual Retirement Account. And with those, you're actually able to contribute up to $57,000 or 25% of your wages, whatever you end up paying yourself. There's also what's called the self-directed IRA, which is something that you can open on the individual and the business side. Self-directed IRAs, you can contribute up to $6,000. One of the benefits of contributing to a self-directed IRA is that you're able to invest in more types of things. So for instance, like if you have a traditional 401k with your employer, usually you can only contribute into or invest into a mutual fund. So you're pretty limited to the products and the investment vehicles that they have in that portfolio, whether it's Fidelity, whether it's Vanguard, whatever the case is. But then if you create a self-directed IRA, you're actually able to invest in your own stocks. You're able to invest in real estate, actually. So there's just different vehicles there with the self-directed IRA, but there's a ton of other retirement accounts out there. But those are the main ones I like to introduce to people, because a lot of people, unfortunately, are not even taking advantage of those.
Yeah. And I think even like entrepreneurs sometimes don't even think that they can have individual retirement accounts. And that number, 57,000, I remember the first time I saw that, I was blown away that you could put 57,000 away as opposed to 19. Thanks for bringing that up.
Yeah, my pleasure.
So how did you become a tax strategist? Walk us through your journey.
My journey is very interesting, really, with me. So as you can guess, so my name is Michel. So that is a French name. So with that, my parents are actually Haitian. So my parents came to the United States from Haiti to provide, a unique opportunity for my family and I. I grew up with two sisters and we lived in the United States. We actually are from Miami, Florida. So we lived in Miami, Florida. And, with that experience, I had some interesting things that happened that I experienced growing up. So one of the things I noticed was, one, my parents were actually entrepreneurs. They actually owned a tax practice in Miami. And I wasn't planning on getting into taxes. That was even the route I was going, but I knew I wanted to be an entrepreneur. I saw the ability and the freedom that they had to be entrepreneurs. But then, as I was growing up, I had some pretty traumatic things happen. One of the things being that, my father was he was incarcerated. So I had to experience and witness him going to jail. Also, ultimately, he ended up getting deported and being sent back to Haiti because of that. So that was one thing that I noticed, and coincidentally, which is very interesting and kind of really what made me be a little bit more of an advocate in showing people how to do taxes correctly, is that coincidentally he actually ended up going to jail because he was doing things that he wasn't supposed to with taxes, unfortunately. So that led him to getting kicked out the country. And so for me, one of the things I noticed was, I saw the impact that that had on my family. And I knew that whenever I became an adult, that I was going to do things legally, ethically, making sure that I also provide sound advice as it relates to taxes. I try to be very conservative because I understand the impact of not doing taxes and not doing things legally and ethically. So ended up growing up, went to school for business administration, was taking accounting classes, ended up doing very well in the accounting classes. And I learned from one of my professors, like, hey, if you want to be an entrepreneur, getting into accounting is going to open up many doors for you. Accounting is the language of business. Ended up taking that advice, ended up pursuing accounting. And then one of the things I noticed was that there's just a very high demand for people to get their taxes done. Taxes is a need-based business, got into taxes. And, I had this interesting experience. I was volunteering for basically it's a program called VITA. So basically you're able to do taxes for free for people. Mm-hmm. I was volunteering doing taxes for free. So usually for lower income individuals, I was working with this couple and, I was going through taxes and I completed a tax return. And, when I completed it, the husband turned to me and asked me like, well, how do we proactively save money on taxes? Like, how do I save money for taxes next year? And I froze. I didn't know what to tell him. I didn't really have any good advice because from my experience when I was in school and, even working in the industry, I didn't really learn, honestly, a ton about business taxes. From my experience, even as a CPA, to me, my experience was that it's really geared towards having you work in corporate America. And a lot of that stuff required a lot of self-education. So for me, I invested hundreds of thousands of dollars learning from the top tax attorneys and lawyers and experts about this information. And that's kind of how I got into it. And, fortunately, I've been able to help my clients, help thousands of people save 5 to 7 figures in taxes legally and ethically. In total, probably, I think I'm probably over $10 million in savings for the clients over their lifetime. So it's been a blessing. It's been an amazing experience because a lot of people are getting their taxes done, but they don't understand, especially in our community, we don't know about some of the things that are available for business owners as far as saving money on taxes. So, just getting that information and helping people implement it even with the way my approach is, I try to make it easy because, tax is not the most interesting subject. So I try to make it fun. I try to make it entertaining. I really love hip hop. So I'm a huge hip hop fan. So I actually wrote a rap called The 10 Tax Commandments. And it's a whole rap song breaking down some commandments. I might rap it. I don't know. We got some time. But yeah, just really breaking down, taxes in an interesting way, so just giving my unique perspective on that. So that's kind of my journey, my experience.
You've said so much just now. One thing that stood out is it's interesting how your childhood trauma and your father's mistake somewhat led you to your path and wanting to do things differently or the right way.
Yeah, that's absolutely it. It's just like, especially even looking at it as an adult, it's crazy how it turned out. Like I said, I didn't plan it that way. Maybe it's just something subconsciously that, I had in the back of my head and, ultimately led me to pursuing this career path. So yeah, it's been fun. It's been great. It's opened a lot of doors for me just to be able to meet people and really be able to help them and get them this information and just continue to share the wealth.
Earlier, you mentioned that a client, or not a client, when you were volunteering, someone asked you questions about actual tax planning, right? Do you mind telling us what, efficient tax planning strategy looks like? When does it happen? When should you start planning so that you can save money on taxes?
Yeah, that's a great question. If you don't have an efficient tax strategy, more than half of your income can go to paying money in taxes. A lot of people don't realize that taxes are your single largest expense. So when you think about it, when you make money, you pay income tax. When you buy something, you pay sales tax. When you purchase property, you pay property tax. When you sell the property for more than what you pay for, you pay capital gains tax. When you die, right, someone could potentially pay estate tax. But even with all these taxes, right, but I think the biggest tax of them all is what I call ignorance tax. When I say ignorance tax, I don't mean that in a rude or condescending way. If you look at the word ignorance, it just means a lack of knowledge and information. And because people don't have the knowledge as it relates to saving money on taxes, they end up overpaying in taxes. Not only that, they end up either potentially owing money in taxes, they end up paying fines, penalties, even doing jail time, like I mentioned. So all these different things could lead to that. So, what I tell people is that the best time to learn how to save money on taxes is before tax season. Okay. So really the main strategy and the main goal is to learn about these strategies and implement them before the end of the year. So that's number one. Number two is making sure that you're organized to be able to take advantage of them. And as it relates to saving money on taxes, there's really 6 big ways to save money on taxes. So the first one is maximizing deductions. So essentially what a deduction is what's called a tax write-off. So when people say tax write-offs, they're talking about deduction. So like I mentioned, as far as being a business owner, let's say just to keep the math simple, you make $1,000 and you spend maybe $300 on advertising for your business. That's a business expense. So your taxable income originally was $1,000. Now you're spending $300,000 on advertising. So you're left with $700 as your taxable income. Your taxable income is the number that they're looking at to determine what you have to pay in taxes. And let's say your tax rate is 30%. Now you're looking at potentially paying $210 just to keep the math simple versus $300 if you didn't have any deductions. So maximizing your deductions, understanding what deductions you could take is going to be key. And as it relates to being able to maximize your deductions, I actually came up with that acronym. One of the acronyms I came up with as far as what you could write off for business is what I call tax-free deductions. So free is the acronym. So the first part of that free, the expense or deduction needs to be for your business, for your trade, business, or profession. So, and see what expenses are related to that in order for you to be able to generate a profit and revenue for that business. The second part of that is ours. The expense needs to be considered regular for your business. The IRS calls that ordinary. So what an ordinary expense for one business is going to be potentially different for another business. So let's say, for instance, one of my good friends, she owns an ice cream shop. I'm a CPA, so I have an accounting firm. So what makes sense for that business, for the ice cream business, is being able to write off for ice cream cones, cups, spoons, etc. As a CPA, that doesn't make a ton of sense for me to be able to write that off, right? So I have to make sure that's ordinary for that type of business. The third part of that is essential. So it needs to be considered essential for your business. The IRS calls that necessary for your business. So necessary business expenses are going to be hiring employees, paying for rents, paying for utilities, etc. Those things are essential business expenses. The last one is economical. So it needs to be considered economical. The IRS calls that not lavish or extravagant under the circumstances. So for instance, one tax strategy is being able to write off a vehicle that weighs over 6,000 pounds. But from an economical standpoint, you need to determine how much money and how much revenue am I bringing in for my business. So if you're only bringing in $5,000, it doesn't make sense for you to write off a $150,000 vehicle. But if you're making millions and millions of dollars, then, $150,000 may be considered economical for your particular business. Again, you want to make sure that it's for business purposes. That's just maximizing deductions. And with deductions, some common deductions that you can take as a business owner, like I said, is meals, travel, advertising, buying supplies, buying equipment being your laptop, your cell phone, your computer, printers, a fax machine if people are still using fax machines, cameras can be written off. Another common one is being able to pay for education. So that's another thing too. So if you are, a lot of times as a business owner, one of the things that help really grow me and my business is investing in education, learning, and investing in mentors. And like I mentioned, when I invested hundreds of thousands of dollars investing in learning from the top tax professionals in the country, that's a tax write-off because it's going to help me pursue and generate more revenue and more profit for my business. So we talked about retirement for self-employed individuals. You have the solo 401ks, the SEP IRAs, you have defined benefit plans. You have a ton of other retirement accounts that you could look into as a business owner. Then you also have legal entity. Legal entity is also going to be a very important concept and thing for business owners to look into, because with your legal entity, it can actually impact what you pay in taxes. But specifically with the legal entity, it's really going to be your tax entity, which determines how you're going to be taxed. So for instance, the tax entities are going to be your sole proprietorships, your partnerships, your S corporations, and C corporations. Based on what tax entity that you have, that can determine what you pay in taxes. So for instance, let's say your business is making $100,000. Basically, the way it works with a sole proprietorship is that you have to pay what's called self-employment tax. Self-employment tax is 15.3%. That 15.3% includes FICA, Social Security, Medicare. So that's pretty much the same or similar to what you would be paying at a 9 to 5, except your employer is paying half of that. So your employer is paying 7.65% of that Medicare and FICA, et cetera. And then you're paying 7.65% for that amount. As a business owner, you're responsible for that full amount. And as a sole proprietorship, you have to pay that full amount on the profit that you're paying yourself. So one of the strategies is if you convert and switch over to what's called an S corporation, you can do that by filing what's called a form called 2553. So 2553. If you go ahead and do that on a timely basis, the timely deadline to do that is March 15th. You can do what's called a late S election. Definitely want to work with a professional to help you do that. But if you went ahead and switched over to an S corporation, instead of paying 15.3% on the profit of the business, you're now paying 15.3% on the salary that you pay yourself. So that's one of the requirements to be an S corporation, is that you have to pay yourself a reasonable compensation. So let's say you pay yourself half of that. Let's say you pay yourself $50,000. So now instead of paying $15,300 in taxes for self-employment taxes, now you're paying half of that, which is like $7,650, I believe, is how the math works out on that. So that is tax entities. And there's so much more. I know I can go on and on, but
So when is the right time to, I guess, switch over from LLC to S Corp?
Yeah, I love that question. So that's an important thing to note. So really the best time to switch over from a sole proprietorship to an S corporation is when you're making more than $50,000 in profit. It's really that break-even point where it really makes the most sense. It's not a requirement. You could do it when you're making less than that, but you're probably going to end up paying more money because with the S corporation, it's just a more expensive tax return that you have to do. You have to put yourself on payroll. It's just a lot more complicated. You definitely have to make sure you're doing your bookkeeping correctly because that is one of the requirements as well. And then one thing that you mentioned with the LLC is this. So I talked about legal entities. So legal entities don't necessarily have a tax impact. So they do and they don't. So with legal entities, they have a default tax entity, which is how your taxes are determined. But with legal entities, your legal entities are registered with the state. So your legal entities are going to be your sole proprietorships, partnerships, LLCs, which is limited liability companies, and your corporations. So those are registered with the state. Again, those are really there for legal protection. So the two entities that give you legal protection are going to be your LLCs and your corporation. So in the event that your business gets sued, the LLC and the corporation will create a separation between yourself and your business. So one of the things that people come after if you didn't have that protection is your personal assets, your savings account, your house, your car, etc. So that having the right legal entity is going to also protect you too. So really a really good combination if you're making more than $50,000 in profit is to either have an LLC or an S corporation, because then you have the profit protection from the S corporation, you have the asset protection from the LLC or corporation if you decide to have a corporation.
So, and hearing you, if you don't want anybody to go after your personal assets, you need to at least make sure that you have your business properly registered. That's the first.
Yes, absolutely. Yep, an LLC or a corporation, for sure.
So you talked about all of the tax write-offs and the opportunities to build wealth through tax savings. And, some of the listeners are probably thinking, maybe I should start a business. But are there any requirements? Like, should your business make money? Can you just continue to take those write-offs every year, even if your business is not generating any real income?
Yeah, that's a great question. So when you're getting into business, you want to be in the pursuit of profit. So that is one of the things that the IRS is looking at. Are you actually in the pursuit of profit? And one of the things that they look at is how profitable are you? So it's absolutely normal if your business happens to show a loss in the first year. So that's common. A lot of businesses, they're investing a lot into their business in order to get off the ground. So showing your business as a loss, that's common. That's not an issue. But one of the things that the IRS looks at is if you have too many losses consistently, then they're potentially could consider your business as a hobby. So there's something called the hobby loss rule, which basically states if you show a loss and sustain a loss for 3 out of 5 years, then the IRS can come back and say, hey, this is actually a hobby. This is not a real business. You're just using this as a way to be able to reduce your tax liability, because if you're showing a loss, if you have a pass-through entity such as the LLC, then the losses from that business can be applied to your personal income. and reduce your tax liability. So no, is it okay? It's possible for you to show that loss, but you don't want to show it too many times because, like I said, it could end up being a situation to where they're going to call it a hobby. And then the even worse part about that is then they can go back and disallow all the expenses that you had in the past. So they're going to say, well, this was a hobby the whole time. And because this is for personal, which we don't care about, then we're going to say all those expenses and all the things you wrote off for your personal life. And then you can no longer take those expenses. And like I said, and that's the interesting thing about it. Sometimes it's very similar expenses. Let's say you are going to an event and you are meeting with your business partner. You're going to a conference, a seminar. That is a business deduction. But in your personal life, if you're going to a conference, seminar, event, and it's not for business purposes, then it's not a deductible expense. So again, having a legitimate business is key, and being in the pursuit of profit and showing that profit as soon as you can is going to be extremely important.
So is there anything that someone who's not a business owner can do to save money on taxes outside of, investing in their retirement account?
Yeah, there are some things that you can do as an individual. Like I said, it is a little bit limited, but in addition to, like you mentioned, retirement, you also have what are called itemizing deductions. So itemized deduction, taking a step back. So business owner, non-business owner, you get what's called a standard deduction. A standard deduction is basically the automatic deduction that the IRS gives you each year. So if you are an individual and in 2021, you're able to get a standard deduction of $12,550. If you're married, they usually double that. So that's going to be $25,100. Head of household, married, filing separately, it all has different standard deduction amounts. But then you're also able to take what are called itemized deductions. So itemized deductions is kind of how it sounds like. So you're itemizing and you're listing out different deductions that you could take. And if those deductions exceed or are higher than the standard deduction amount, then you're able to get a bigger deduction. So common itemized deductions is state and local taxes. That's an itemized deduction. Mortgage interest. So if you have a home, being a homeowner is something that the government wants to incentivize you to do. So they do give you a tax benefit for having a home, and tax advantage of having a home is you're able to deduct for that mortgage interest. Charitable contributions, you're able to deduct for medical and dental expenses. But because they've actually increased the standard deduction amount when Trump got into office, he actually doubled the standard deduction amounts. It's actually a lot more difficult to meet those thresholds. So, but if you do, right, depending on how much money you're spending and your income level, you might be able to qualify and be able to get that itemized deduction over the standard deduction amount. So that's going to be helpful for you. Another thing that is open to, business owners and individuals is being able to get child tax credits. So if you have children and you have a certain income level, I believe it's under 200,000, then you're able to get some tax credits for having children. As far as like on the individual side, those are like the main areas, unfortunately. So like I said, the real goal is to have a business because that's when things really open up for you.
Thanks for clarifying that.
Yeah, my pleasure.
So Michel, you are using social media to expand your business.
Yes.
And, you shared that you were on track to hit 7 figures this year.
Yes.
How are you earning money outside of providing tax strategy services to your clients?
Yeah, so really there's a couple things. So providing tax strategy advice for my clients, that's one way that I'm generating revenue and income. Also, as far as the traditional accounting services, bookkeeping, tax preparation, so that's another stream of income for myself. I'm also, have courses and programs. So people go ahead and if they want to, let's say they can't afford to necessarily work with me one-on-one, they can invest into one of my courses and be able to learn about taxes that way, along with some other business strategies, also getting paid from speaking engagements, sponsorships. Even something that my wife and I are doing is we have investment property. So yeah, there's a quote that's out there that says, if you only have one stream of income, you're like basically one step away from being broke. I tend to, make sure I have some multiple streams of income and, continue to grow my wealth.
That's definitely something that we encourage the dreamers to do, build multiple streams of income.
Absolutely.
Can you talk to me about your best money move so far?
Ooh, my best money move. I would say, honestly, I think probably investing in real estate was probably one of our better money moves. My wife and I'll give my wife credit because she was the one who really pushed it and wanted us to really get into real estate. But I think that's one of our best money moves because one, the income from that is passive. We're building equity and we can continue to grow our portfolio and invest in some more properties and real estate. And it's just like real estate has always been, probably one of the strongest investments, out there. One, there's a ton of tax benefits and incentives, one of them being depreciation, which is basically expensing the purchase price of the property over a period of time. If it's a residential property, it's 27.5 years, commercial is 39 years. So that's a huge tax incentive. So I think that would probably be one. And then, with real estate, with the way we're doing it is more of a more on the equity side. So it's not significant cash flow, right now, but, over time, as we continue to grow our portfolio and get more and more, it's going to continue to grow and multiply. So I think that's probably one of the better money moves we've made.
Love it. So, Michel, I'd like to end the interview with a round of rapid fire questions.
All right.
Tell me about a book that changed your perspective on life.
For me, it's Rich Dad, Poor Dad. That was a book that I read when I was actually in high school. I was visiting it's a rapid question. Let me not give a whole story behind it. Rich Dad, Poor Dad by Robert Kiyosaki. Great book. Check it out. Definitely changed my perspective on money, business, and just life.
What's one thing about money you wish you could tell your younger self?
Really invest in yourself. Making the investment in yourself is the best investment that you can make.
What's the best investment in yourself you ever made?
Just, I think, investing in courses and, personal development. For me, actually, there's a lot of things I need to learn. So investing in myself in the business world helped me save a lot of time.
Fill in the blanks in 3 words or less. Money to me is?
Say freedom.
What do you want your legacy to be?
Or is it 3 words or less?
Oh, no.
Okay. I was like, ooh, that's it. I got to think about that one. Yeah, my legacy to me is really one of the things that I do is when I wake up in the morning, I write down a list of goals and things that I want to do. And one of the things I write down every day is that I want to create a financial transformation for over 1 million people. So financial transformation being that, helping 1 million people either create a business, either be able to generate 6 figures or more, and just really be able to achieve financial freedom, like a significant change in their life as it relates to finances.
How about
10 tax commandments? Of course, I'll be honored. I love to rap it. So yeah, like I said, 10 tax commandments is a rap that I wrote as it relates to taxes. So here it goes. I've been in this game for years. It made me an animal. There's rules to this code. I wrote me a manual, a step-by-step booklet for you to get your game on track. The feds off your back. Rule nombre uno. Let the IRS know how much dough you hold. Because, evasion breeds penalties, especially if that prep messed up. Watch your tax go up. Number 2, document expenses you could prove. Don't you know them boys treat lying like violence? Take it from your highness. I done see mad cats and chicks cut for their schemes and tricks. Number 3, go form an LLC. A lawyer set that up. Properly draft up. Deed in the state up. Yep, for them big bucks. They'll get that paperwork cleaned up. Word up. Number 4, I know you heard this before. Always rely on your CPA guy. Number 5, never tax prep where you rest at. I don't care if they tell them leave. I don't care if they do it free. Tell them leave. Number 6, that's tax advance credit. That it. You think they're doing you a favor? Nope, forget it. 7, this rule is so underrated. Keep your personal and the business completely separated. Business and blood don't mix like politics with no tricks. Find your business serious risk. Number 8, know the date your taxes due. If you miss a deadline, they'll be coming for you. Number 9 should have been number 1 to me. If you start a business, stay away from hobbies. If they thinking it's a hobby, they ain't trying to listen. You'll be stressing in the kitchen when them letters start hitting. Number 10, a strong word corporation, strictly for bizmen, not for freshmen. If you ain't got investors, then say hell no, because they gonna want their money rain, sleet, hell, snow. Follow these rules, you have mad bread to break up. If not, 24 years on the wake up. Flow hit your tempo, watch your frame shake up. Caretaker, did you make up? When you pass my bag, I hope you rake up a lot of cash for beachfront in Jamaica with the Michelin star chef to hook a steak up. Gotta go, more returns to make up. Word up, Tax King.
That was brilliant.
Thank you.
Definitely a first on the podcast.
Thank you. I'm glad that, I was able to be one of the first entrepreneurial rappers on here, and that's an honor.
Can you tell our listeners where they can find you?
Absolutely. So definitely feel free to check me out on social media. My Instagram and pretty much all my pages are at Michel Valbrun. So it's MICHELVALBRUN. So that's Michel Valbrun on all social media platforms. I'm most active on Instagram and just giving out, free advice, free content, just really helping our community get this information. And then also to have a program called Tax Wealth 101, talking about a lot of the information that just shared on this podcast, along with hours and hours of content as far as different ways that you can save money on taxes legally and ethically. So you can check that out at taxwealth101.com.
Thank you so much, Michel.
My pleasure. Thank you so much for having me.
Thank you for listening to today's episode of the Dreamers Podcast. You can find the episode show notes and all of the links mentioned at dreamoflegacy.com. If you liked today's episode, here's what you can do to support me and help more dreamers discover the podcast. Follow the podcast on Apple Podcasts or wherever you listen to podcasts. Rate and review the podcast to help the podcast gain more visibility. Share the podcast with your family, friends, and coworkers. And if you really enjoyed today's episode, please take a second to tag me at thedreamers.podcast on Instagram and let me know what you liked about today's episode. All right, dreamers, that's it for today. I will see you back here next week for another episode of the Dreamers Podcast.
Okay, dreamers, time to build this legacy.
This podcast is for general information purposes only. It is not intended to provide any tax, legal, financial planning, insurance, accounting, investment, or any other kind of professional advice or services. Please consult with an appropriate tax, financial, or legal professional to receive appropriate advice based on your situation.
Sunday, Skincare Day, is one of the ways I keep my sanity in these crazy times. Dreamino is an all-natural, Black-owned skincare brand carefully handcrafted by parents who could not find the proper care solutions to address their family skin problems. All Dreamino products are made of organic and high-quality ingredients, meticulously chosen to give your skin the smooth results and the glow it deserves.